Welcome to Yadnya Investment Academy. Through our fund analysis series, we had reviewed some of the most popular large cap funds. And in this video, we are going to compare all of them. Friends, large cap funds being equity funds, you should invest into these only when your investment horizon is more than 5 years away. That is, you are investing for the long term. Now, large cap funds would suit people who have a moderate risk profile. Moderate risk profile as in people who want to gain from equity investments but don't want to go for aggressive investments. Large cap funds are the least riskier funds when it comes to equity investing. Or you should go for large cap funds when your goal needs returns of around 12% on an annual basis. Now in this video, you would see that large cap funds have given returns way higher than 12%, but returns of 12% on an annual basis is a realistic expectation from large cap funds. Now the large cap funds we are going to compare here are Birla Sun Life Frontline Equity Fund, HDFC Top 200 Fund, ICICI Prudential Focused Blue Chip Equity Fund, Franklin India Blue Chip Fund and SBI Blue Chip Fund. Now all these funds follow different indices. Birla and HDFC funds follow S&P BSE 200. ICICI Fund follows Nifty 50, Franklin India Blue Chip Fund follows S&P BSE Sensex and SBI Blue Chip Fund follows S&P BSE 100. But usually large cap funds would invest into the companies that form the Nifty 50. If you check the portfolios of all these funds, you would see that the portfolio is made of around 50 stocks. So we'll compare the returns of all these funds with the benchmark Nifty 50. And as far as the index dependent risk return parameters beta, R square and alpha are concerned, we'll compare them with individual benchmarks. The value of standard deviation indicates the amount by which the returns of a fund may go up or down in correlation with its mean. So the first three funds, that is the Birla, HDFC and ICICI funds, are volatile as compared with the index. A beta value tells us how closely is the fund's portfolio correlated with that of the index, and an R squared value tells us how reliable is this beta. So an R squared value greater than 0.8 is what is desirable, and in this case all the funds have an R squared value greater than 0.8, indicating that these betas are highly reliable. A beta value greater than 1 indicates that the fund would gain more when the index moves up and the fund would fall more when the index falls. But we cannot look at beta into isolation, so let's move ahead and look at the other parameters. An alpha indicates the amount of returns generated by a fund over and above the ones predicted by its beta value. And here all the funds have generated an alpha of around 4 to 6%. But SBI Blue Chip Fund has done an excellent job of producing an alpha of around 9% over and above the ones predicted by its beta value. Sharpe ratio is the amount of returns generated by a fund per unit of risk taken. So if we look at the Sharpe ratio values of all these funds, it indicates that SBI Blue Chip Fund is able to generate more returns for the less amount of risk it is taking. A turnover of 67% indicates that 67% of a fund's portfolio has been replaced in the last 1 year. Now, a higher turnover indicates higher churning of the portfolio, which is associated with trading costs, but you should be bothered about these figures only if higher churning has not been converted into higher returns for you. An expense ratio is the amount of fee charged by a mutual fund. It is a percentage of total assets managed by the mutual fund and is straightaway taken from the profits generated by the mutual fund for its investors. So a lower expense ratio is what is desirable, but you should be bothered about this figure only when the difference between returns generated by two mutual funds is big enough. Now the amount of assets under management indicate the amount of trust the investors have in the fund. Franklin India Blue Chip Fund was launched in December 93 but still has the lowest amount of assets under management among these 5 funds. Now if a fund has a PE ratio lower than that of the index, it indicates that the portfolio of the fund has potential for growth. And here All the 5 funds have a PE ratio lower than that of Nifty 50, indicating that the portfolio has potential for growth. Now, PE and average market capitalization. Average market capitalization is nothing but the average of market capitalization of all the stocks held by a mutual fund. Now, these two are temporary figures, so I have highlighted them into red because the PE and the market cap could change the next day. But yes, these figures could be indicative. Here I have put the market capitalization of the individual indices as well, so that we can compare the market capitalization of the index with that of the fund. Now I have not put the specific holdings of each fund into giant, large, mid and small cap stocks, but just to give you an idea, the Birla fund holds around 15% of its allocation to mid caps, HDFC fund holds around 10% of its allocation to mid caps, ICICI and Franklin funds hold less than 5% of its allocation into mid caps, and SBI Blue Chip fund holds around 17% of its allocation to mid caps and the rest into large cap stocks. But a higher Sharpe ratio in case of SBI Blue Chip fund also indicates the amount of returns it is able to generate even when it has a higher allocation into mid caps. Now the proportion of mid cap stocks could tell you the amount of risk associated with the fund, but yes, risk is again proportional to the amount of returns you could get out of that fund. You can look at the other risk return parameters like the Sharpe ratio and verify whether the fund is able to mitigate the amount of risk or no. Now come the trailing returns. All the funds as compared to Nifty 50 have done well in 1, 3, 5, 7 and 10-year trailing returns. Now trailing returns at time may not give you a very true picture. Like in the case of HDFC Top 200 fund, good 1-year performance has lifted its 7, 5, 3 and 1-year trailing returns. Let's move on to the calendar returns. If we look at the calendar returns of Birla Sun Life Frontline Equity Fund, the fund has beaten the benchmark Nifty 50 in all the calendar years. It has shown better capacity to control losses when the market was down in the years 2008, 11, 13 and 15, and also it has shown good performance in the testing time of 2016. But a higher allocation to mid caps and a Sharpe ratio below 1 make it a high risk fund suitable for risk-savvy investors. If we look at the calendar returns of HDFC Top 200 fund, in the years when the market moved down, twice it was able to control its losses better than that of the benchmark. But in the recent years of 2013 and 15, it slipped below the benchmark. And again in 2016, it showed good performance. So inconsistent recent performance, a higher beta value with a Sharpe ratio same as that of the benchmark S&P BSE 200 make it a high risk fund which can give you a real bumpy ride. ICICI Prudential Focused Blue Chip Equity Fund has consistently beaten its benchmark in all the calendar years except 2012, and even here the difference between the returns of the benchmark and that of the fund was less than 1%. The fund has shown better capacity to control losses when the market was down in the years 2011, 13 and 15, though it has not seen the downside of the market in 2008. But in the years when the market was up, it has shown real great performance by delivering very good returns for its investors. So consistent calendar and trailing returns and a higher allocation to large caps make it a below average risk fund, and as we have seen that the fund can give you real good performance when the markets move up as the fund's good bets pay off. If we look at the calendar returns of Franklin India Blue Chip Fund, the fund has not been able to beat the benchmark Nifty 50 in the years 2007 and 2013. But the recent performance has improved with a larger margin by which the benchmark is beaten. A low turnover is an indicator of buy and hold kind of a strategy. Its higher allocation to large cap stocks refrain it from generating higher profits, proving it to be an average risk fund for conservative investors. If we look at the calendar returns of SBI Blue Chip Fund, the fund did not have a real good start in 2007, but after 2010, the fund has shown real robust performance. The fund has shown better capacity to control losses when the markets moved down in the years 2011, 13 and 15. A higher exposure to mid caps But at the same time, a high Sharpe ratio indicates the right buy calls taken by the fund manager, making it to be a low risk, high performance fund. If you look at the managers seem to have spent real good time with the fund. Last but not the least, let us look at the corpus created by an SIP in all these funds, where the SIP was for 5 years and the monthly investment was 10,000 rupees. So, for a total investment of 6 lakh rupees, a corpus of 9.23 lakhs was created by Birla Sun Life Frontline Equity Fund. A corpus of 8.9 lakh rupees was created by the HDFC Fund. A corpus of 8.88 lakhs was created by the ICICI Fund. A corpus of 8.58 lakhs was created by Franklin India Blue Chip Fund, and a corpus of 9.44 lakhs was created by SBI Blue Chip Fund. This brings us to the end of the video. Hope you now know which of these 5 funds suit what kind of investors. Thanks for watching this video. Watch this space for more such topics. Until then, happy investing.